Copyright in these lectures is either owned by the ANU or a third party who has licensed the ANU to use it. Students may use the recording for personal study only. No lecture may be communicated online, copied or shared without the prior permission of the ANU.
Okay, before we continue our discussion of how we're going to reorganize the financial statement of Woolworths from last week, I'd like to correct myself. After last week's workshop, students in the class approached me to ask me what's the operating revenue from continued operations, and she asked me if she should use that number or the $55 billion. I gave her the wrong answer. You should use this number, as this is the consolidated revenue from the continued operations, and the company as a consolidated business group, they receive from external parties, from their customers. So that will include that $1 billion of internal revenue. So the revenue between the between the companies within the business group. So that $1 billion might be the transaction between its liquor business and its hotel or retail food business. So that can be internal transaction. It should not be included as part of the consolidated revenue. I gave her the answer that using this number, I took it for granted. This is the consolidated number, this is negative. Actually, it starts from the consolidated number and go back to the total revenue on the book. So if you have similar question and the answer is that only use the audited consolidated number from the financial report of Woolies. Then let's continue our discussion of some important accounting items from the P&L. Last week, I didn't have time to talk about the intangible assets. So let's have a look at the intangible asset. This is a very detailed table of the intangible assets. I chose Woolworths for you to do the valuation exercise for that very good reason, because they have very comprehensive portfolio of intangible assets and large number of operating lease, so that you have the chance to do the exercises. So if you look at the table of intangible assets for Woolies, you will see a few categories. Goodwill, that's the premium they have paid in previous merger acquisitions that the management team couldn't find a place to book it on their balance sheet. So when they acquire a subsidiary, a fully controlled subsidiary, for instance, they're going to consolidate that subsidiary on the company's balance sheet. They're going to include the PPE, intangible assets, but remember this, they have, usually in most cases, they have to pay a premium to purchase the assets of the company or control of the company, which exceeds the market value of the subsidiary. So on the balance sheet, they cannot find any accounting items to book that premium. So they create this accounting item, goodwill. So it represents the net present value of future cash flows that can be generated after consolidating the subsidiary into the business group. So that's how goodwill is originated and how it's treated in accounting. So it's just an accounting item. You won't see anything actual because all the PPE, the actual property portfolio, the actual intellectual property will be consolidated on the balance sheet of Woolies. And brand names, many of the brand names, the value actually for Woolies were from acquisitions and mergers. Liquor, gaming license, and other, they don't disclose the other, so we just assume they're just licensed. They are the result of past merger acquisitions. So it's very likely these two items will be acquired intangible assets as a result of their past merger acquisition, the expansion of the company's asset portfolio. So that will give you, for 2017 financial year, a total carrying amount of about $6 billion of intangible assets. Okay, still let's do a trade-off. Is it worthwhile to study in some depth of its intangible assets, especially goodwill, because they are not actual assets you can observe standing there like a concrete. They are intangible, and in other words, the valuation of these assets, especially goodwill and brand names, are very controversial and subject to the manipulation of managers and their discretion. But these are the funds that the company has invested. They have used the funds to, in the past, merger acquisitions, and that's a huge amount of money. Currently, it sits at $6.5 billion. The capital has been provided by capital providers, shareholders, bondholders, banks to finance this investment in asset. So consider the total assets, the size of the total assets of the company, and the revenue of the company. Is it substantial? Does it require additional analysis? What's the total assets value of the company in 2017? Okay, we better have a look. Okay. Consolidated statement of financial position and total assets, about $23 billion. Okay, total assets, $23 billion, and we have, let's go back here. $6.5 billion current value of the intangible assets. Is it substantial? Yes, it is. And if you consider the $50 billion of revenue, and this number can be very substantial for the company, and it does rely on this, the liquor gaming license, to generate future revenues. So given this, the size of the intangible assets, it does require us to put some efforts into its history of amortization, impairment, and if you look at the composition of the intangible assets, more than 2/3 will be in goodwill. So that's even another highlight. Okay, we got to put some efforts into the analysis of the goodwill because they are very controversial and can be a way that management uses to manipulate the reported earnings or other performance measures. So the items related to goodwill will be input into KGW model to generate ROIC measures, excluding goodwill, including goodwill. And if you look at the accumulated amortization, there was some legacy from the old accounting system when the goodwills, such brand names and goodwills, were allowed to be amortized. So all of this represents some past investment, actual cash provided by capital providers to make investment in merger acquisitions, and they were amortized, or so-called the value of the goodwill or brand names were reduced in this way. So we'll do a more detailed analysis in the context of the KGW model, see what kind of intangible asset items we need in the KGW model to facilitate our better measure of the company's performance, especially invested capital. So obviously, goodwill write-down, that's an accounting item you might find on the P&L that the management decides, okay, we paid this amount of premium in the past, it's recorded as assets on the balance sheet, but right now we consider, okay, the premium we have paid past is not worth that amount of money anymore. If we have paid $500 million of premium, which will be recorded as goodwill on the balance sheet, now we got to evaluate the net present value of the additional cash flow generated by consolidating that acquired subsidiary into the business group. We assume, okay, it looks like it's going to be very difficult to generate this amount of $500 million of additional cash flow in the future. And after meeting with accountants, after running some models, they decide, okay, we assume the net present value of the additional cash flow generated by consolidating the acquired subsidiary into the business group is only worth $250 million now. So that reduction of the goodwill will be recorded on the P&L as write-down. So usually, for Australian listed companies, they usually following the accounting rules of international financial reporting standards that to just record goodwill write-down as an expense. It's non-cash expense, it's not tax deductible because it's asset write-down. Any asset write-down for this kind of business are not tax deductible, but it's a reduction of the reported profit for the company. That's goodwill write-down. If you scroll down to line 42, you will find another item on the statement of shareholder equity. It's goodwill written off. Goodwill written off, it's in essence, it's actually very similar to goodwill write-down. The only difference that it's not recognized on P&L. Instead, it's the management decides, okay, the premium, $500 million of premium we have paid in past merger acquisitions is worth nothing, zero. So instead of recording this loss of $500 million on P&L, they're going to reduce the equity attributable to shareholders by $500 million. It's going to be recognized on the statement of equity. So either way will lead to a reduction of wealth attributable to shareholders, just because of the how they recognize the goodwill reduction, the value of goodwill reduction. It leads to different items on the P&L, on the financial statement. So if you have an item from the notes of the company like goodwill write-off, written off, it should go into 42. If you only find goodwill write-down, it's like asset impairment, it should go in here. And amortization of intangible assets. This item should be actually amortization of acquired intangibles. We are following the International Financial Reporting Standards, which was obliged to be adopted by Australian listed companies since 2005. They were given a few years to fully comply with the IFRS, and they treat the acquired intangible assets other than goodwill in a prudent way. In a sense, it's better to be listed as a separate item on the P&L, and also for the KGW model. So it's still related to the past merger acquisitions. You will find this number from the notes of Woolies. Amortization only applies to assets with a definite life. For instance, the gaming or liquor license. But with other intangible assets, that brand name, we assume it got indefinite life. It's going to be treated like goodwill. So any write-down, the value with loss of brand name should go into line 16. So although it's named as goodwill write-down, but this should include the intangible assets of indefinite life, because they are not replenishable. But with a gaming liquor license, you got to renew your license. You got to make additional investment. It's got an expiry date of how long you may use that license to generate future revenue. The amortization of another category of intangible assets is the internally generated intangible assets. The best example will be the software systems, like for UPS and FedEx. They rely on that parcel management system to generate their revenue. It's the core component of their capital investment. So with these internally generated assets, the amortization should go in 14, which is non-cash expense. To be exact, although it's depreciation expense, it's actually non-cash operating expense. So it includes depreciation of PPE, amortization of internally generated intangible assets like software. If you got to read the notes of Woolies, you will find some of its gaming liquor license got expiry date. Some of the license are considered indefinite life. So it's up to you, and they do not give a breakdown of the gaming or liquor license. So it's up to you. You include the license as acquired intangibles with indefinite life, or amortization of definite life. So that will make a small difference in terms of performance measurement and valuation. How these items are incorporated into calculation of ROIC. In the results spreadsheet, you will have this section from 174. That's the section, the mechanism that the KGW model calculates invested capital excluding the goodwill and including the goodwill. You will see other adjustment of working capital, operating provisions, and also value of operating leases with the excluding goodwill invested capital, and of course with the operating invested capital including goodwill, all of the past write-down of goodwills and acquired intangible assets, the amortization of the intangible assets will be included here. Because historically, before 2005, the companies were allowed to amortize intangible assets like brand names and goodwill. So you will still find these items from their annual reports, and all of these will feed into either item here. So they represent the past investment into the company, although you won't find any of the traces of this investment from the balance sheet yet, because they were written off. They're going to be added back to the invested capital, including the goodwill. This tends to dilute the ROIC calculation for the company, because the company, following the accounting rules or the discretion of the management or the board, they have written down the part of the merger acquisition premiums or brand names. They may had like a major scandal, this reduction of the brand name value, but they are assets of the company, and they were financed with some funds from the shareholders and the debt providers. They represent the whole invested capital base for the company. That's why the adjustment for the ROIC calculation will be conducted here. You won't need to do anything by yourself, but it's going to be calculated automatically by the model. But you need to understand the reasonings of this kind of adjustment, all of these items, why they are included here. And when you scroll down to very bottom of the spreadsheet results, and you will see ROIC calculation based on invested capital excluding goodwill, invested capital including goodwill. So they're going to tell quite different stories of the company when you just bring back all of the past goodwill and intangible assets amortization and write down back to its invested capital. From the historical spreadsheet, you have another 2 cells to fill in if you can find any inputs from the annual reports, especially from 2009. Because after 2009, the company has already been adopting international financial reporting standards. There should be no amortization of the goodwill or the brand names. But before that, there might be some accumulated amortizations or written down of goodwills that will be recorded in 2009 annual report that should be filled in here, so that you're going to capture all of the value, all of the funds invested by shareholders and debt holders with regards to goodwill and other acquired intangible assets. So that number is not huge, but for training purpose, I would like you to go back to read these historical accounts and find out if you need to fill in any numbers here. So these are the cumulative goodwill, acquired intangible asset written off before 2009. Any written off of these intangible assets will be captured by 16 and line 17. So we try to have a better, accurate measure of the cumulative goodwill and intangible assets right down. Did I talk about the foreign exchange movement and the cost or loss, the profit or loss on the P&L? I can't remember. No? Okay. So for Woolies, you probably cannot find a separate item of foreign exchange movement, but in their statement of comprehensive income, you'll have an item movement in translation of foreign operations taken to equity. So it depends on how they're going to recognize the impact on profit from the foreign exchange movement. Woolies actually recognizes just a very small number, $3.9 million on the statement of comprehensive income. It's a reduction that's attributable to shareholders of Woolies. So it's part of the loss they make over the year, but it's very likely to be no cash flow. So how can there be no cash flow impact? So the loss or profit from foreign exchange movement on the P&L, sometimes it's just a result of consolidating the financial statements of all of the subsidiaries on the day of 30th of June 2017, and on that day they're going to check the book, the accounting book of the foreign subsidiaries, have a look at, okay, these they make this amount of profit, and we're going to translate, for instance, New Zealand dollar profit from the New Zealand food retailing subsidiary into this amount of $8, because everything has to be reported in $8. But when these revenues or expenses were incurred in the New Zealand subsidiary, they were at a different exchange rate. And they're going to be recognized on the book of the subsidiary at a different amount. So that creates only a difference, a loss of profit on the book. And the company is not selling the New Zealand subsidiary and convert the proceeds from the sale to $8. If that's the case, there will be cash consequences. But they didn't dispose any of their New Zealand food retail shops. So this is very likely to be just a loss on the book. So this can be ignored in your free cash flow calculation. But in case, if the company has disposed of foreign subsidiary, there will be cash flow impact, and it's going to be treated differently, and its impact on the profit and loss of the company will be found profit loss from discontinued operations. So it depends on the nature of that transaction. It might have cash flow impact. It may not have cash flow impact at all. Because Woolies is just very predominantly a domestic business, this number is very small. And they have small scale of use of derivatives to manage the currency risk. But with some companies, especially like company that generates more than half of their revenue from foreign countries, and especially like company like Qantas, very quite international. They have sales in different countries, in different currencies. That impact can be large. If that is significant, it requires additional analysis. I want to talk about this because this is like training. I want you to understand what the context will be in the future. You need to analyze another company. But for Woolies, there's no need to analyze any further or try to identify any cash flow or non-cash flow impact from the foreign currency changes. Next, let's talk about the operating lease. The operating lease is recognized on P&L as operating expense. I don't know where that should go into here. It's branch expenses or administration expenses. We don't know. But it's included in one of the cost items on the P&L as operating expense. So operating lease is the amount of money the company promises to pay to have the right to use that asset to generate their revenue. So it's actually, instead of taking the ownership of that assets, they only lease that assets. There are multiple reasons for operating lease instead of finance lease. In finance lease, they take the ownership, just finance the fixed asset investment with debt. But with operating lease, they do not take their ownership, but they still need to use that asset to generate the operating revenue. In the case of Woolies, that operating lease is used to lease the retail shops, warehouses, these facilities. They are critical for their everyday operation, and it is part of the operation. So why do we want to capitalize the operating lease? It's recognized on P&L as an expense instead of on the balance sheet as fixed asset investment. Let's have a look at the size, and then we decide if it's significant for us to capitalize the operating lease. Right, still no luck. Let me try 94. Maybe that's. Okay. Okay, so in the notes of 4.9, it's commitment for expenditure and operating lease. So it goes together with commitment of capital expenditure. Some way it discloses the nature of this expense recognized on the P&L. It's actually in nature a fixed asset investment. But for risk management purpose and other reasons as well, they don't want to purchase a large portfolio of retail properties. That can be hundreds of retail shops, the actual property. They don't want to own hundreds of retail properties. So they're going to use operating lease. Instead of paying the $24 billion upfront, they choose to do it in installment. So it's more like us. We go to borrow money from the bank to buy a house. We don't have all of the cash that we need to buy the house. We take a loan and we repay regularly at the same amount for every installment. So for Woolies, operating lease is done in a similar fashion, that instead of paying the $24 billion to buy all of hundreds of retail shops, they promise to pay in the next 12 months about $2 billion for all of the retail shops, hundreds of retail shops, the very large retail property portfolio, to use these properties to generate the operation revenue. And up to 5 years, so that means in the time frame of after 12 months until 5 years, they have about $7.7 billion committed, so that they will be able to use this large portfolio of retail shops to generate their operating revenue. And if you look at that, that's almost quite stable. So that's for 1 year expense, rent of $2 billion. For the next 4 years, it's very close to $8 billion. And later than 5 years, so after 5 years, they have the lease agreement in place to pay a total of $14.7 billion in rent, so that they have the use right of these properties to generate their operating revenue. So that's their total capital commitment. I want you to read the notes below this table. You will find that $14.7 billion, that's the lease. They are committed for the property, for some retail and warehousing facilities for up to 40 years. Very long-term, but with a definite life. So they can be capitalized on the balance sheet as depreciable assets. When we capitalize the operating lease, we assume that worth of the right to use all of the properties, $24.4 billion, are going to be paid upfront. Right now, on this day, and it's going to be financed with 100% debt, bank loans. In the KGW model, you will find a few items under off-balance sheet items. They do not show up in the balance sheet, but they are in nature, might change some of your balance sheet items. So the $24 billion of capital commitment for the operating lease is almost the same size as its current total assets. So in other words, this is a very substantial amount of money, capital commitment, and it highlights further that we need to capitalize the operating leases. So to capitalize the operating lease, we have this facility available on the historical spreadsheet that you need to fill in the operating lease expense. That's the number you can read from the notes of the financial statement. That's the operating expense recognized on the P&L. And interest rate on operating lease. So how much money the company has to pay to secure bank loans to finance fully the purchase of the retail shops. So you may go to read the capital management notes of the company and work out a weighted average interest rate that the company has paid for that particular year as an estimate. This is for historical. And in the forecast drivers, you need to forecast that interest rate for operating lease as well. So that may rely on our discussion next week. At least for the historical data, you can find some clues and work out an interest rate for capitalizing the operating lease. And the last input is life of leased assets. I provide you a simplified model to capitalize the operating lease with this expense that you can read from P&L, the interest rate you can estimate from the notes of the bank loans section of the company, and you have to estimate a life of the leased assets. So from the notes, we understand that they have capital investment or operating lease that will be payable in the next 12 months, and up to 5 years and more than 5 years, up to 40 years. So how can we estimate a life of the leased assets? One way is just give the model an estimate. For instance, you get some ideas. For some companies, the leased assets might be in a very simple structure, and they provide an estimate. The company might provide an estimate of the life of the leased assets. You may just use that number. For instance, in this case, I just use 5 years. But for all lease, you may calculate weighted average life of the leased assets. How can we do this? So we can assume that $24 billion of assets will be just composed of 3 pieces of equipment, fixed asset investment. And one piece of equipment will have life of 1 year. And after that 1 year, it's obsolete. And for another piece of equipment, it's about, which I'm going to spend $7.7 billion, up to 5 years. Maybe I take a middle number, like 3 years or 3.5. And for another, the last piece of equipment of $15.7 billion, its life can be up to 40 years, more than 5 years. So I might use 10 years, the life of that piece of equipment, and I can calculate a weighted average life for all of the assets I want to capitalize. So that's one way to estimate the life input in line 102. Given the significance of the operating lease expense and the capitalized value, you will find over here the formula is already there. If you want an explanation of their formula, read the textbook. When you go to change any of these parameters, you will see, when you see significant change of the capitalized value, you probably want to run a sensitivity analysis to see when you change your estimate of the weighted average life of the leased assets and how much the capitalized value of the capitalized operating lease will change. Because that, line 99, will go into the calculation of invested capital. So the capitalized value of operating lease will go into the calculation of invested capital. It may dilute the ROIC estimate, but sometimes it may increase the adjusted ROIC measure. In what way? So when we go back to look at this example, I provide that's a simple example, more straightforward. So that's the expense we read from P&L. If we decide to capitalize this, we should remove this expense from its P&L. That tends to increase the reported profit for the company. And instead, part of that expense, $78 million, will be recognized as depreciation on the balance sheet. So you will, on the balance sheet, you will have higher fixed assets, or in other words, this will lead to higher invested capital, and there will be increased number of depreciation. And another portion of the $78 million of expense will be interest expense of the operating lease. So I'm going to divide the $78 million of operating expense, operating lease, into interest segment and depreciation segment. They're going to be recognized on P&L, the interest expense, and depreciation on the balance sheet. If you fill the KGW model correctly with that operating lease expense, given that you have the estimate of these reasonable estimate for these parameters, this adjustment will be done automatically within the model. The adjustment shows up in the results spreadsheet. In the interest expense, you might try to find out yourself, and the interest expense as a result of capitalizing the operating lease will be adjusted, depreciation will be adjusted as well. And all of these will lead to adjusted NOPLAT and adjusted invested capital. It depends on the size of the operating lease and the amount of interest adjustment or depreciation. You might see the adjusted ROIC go up or go down. But it's a better measure to evaluate the company's performance after you capitalize the operating lease. So make very good use of the results spreadsheet. Try to find out how these are calculated. If you still remember that. When you click that and you have a variable name or formula, you can press F5 on your keyboard, find your variable here. So it's operating lease balance. That number, and click go. It will take you to where that number was calculated. So make yourself familiar with the results spreadsheet, and it's very useful. Although all of the adjustment is going to be done automatically in the model, you still are expected to understand the simple adjustments that's as demonstrated in this example. For forecasting for the next 5 years, so you may read information from the latest annual report of their capital operating lease commitment to fill in that operating lease expense for the next financial year, or you may link that operating lease expense to revenue growth. That's should be forecasted within your group using your forecasting model. So the underlying assumption is that, okay, this is part of the capital investment, the capitalized operating lease, the assets. If you would like to generate this certain level of revenue, you got to, if you do not change the operating efficiency of your company, you got to have higher capital investment or more operating lease investment. So this can be linked to your revenue growth forecast in your model. Or if you don't like these models, just come up with any model you like to forecast the operating lease expense of the company. Read the notes of the company, consider the corporate strategies of the company. Are they really aggressive opening up new shops, or in what area, and how much additional operating lease they need to employ in their future operations to fill in these parameters. Last item would be the tax. Okay, so in the KGW model, we treat tax in a quite straightforward manner, that we value more about the cash flow in terms of tax instead of the accrued tax on the balance sheet of the company, because they may represent a cash flow impact for the company, but may not lead to any cash flow impact. So in turn, they will not affect the valuation of the company. So I don't want you to spend too much time on the tax, and follow whatever needed in the KGW model. Fill in the company tax rate as 30%, and the effective tax rate can be estimated from the historical estimates to make an appropriate estimate. The company does not have huge amount of tax credit or future tax liability, so its effective tax rate can be very stable. It's not like Sydney Airport. If you look at its effective tax rate, it may jump from 0, sometimes negative, 0, and sometimes positive, because of the use of the past operating loss as a result carrying to the following years. So with Woolies, it's going to be quite straightforward. But it's worthwhile to read the notes in terms of significant accounting policies for you to understand how the past operating loss or tax assets can be recorded under a book. Read the paragraphs below the table of tax. That's mostly what I want to discuss, and I won't have time to ask the groups about their progress. If you have any questions or concerns, come to talk to me, especially the new groups of 1921.